This is Matthew Cratter from Trader University, and today I want to talk about the Airbnb IPO and whether I think their stock is a good investment. If you're interested in learning how to make money in both bull and bear markets, or you just want to see what I'm trading or investing in, be sure to hit that subscribe button. And I should say as well before starting that this is just my opinion, just my 2 cents. None of this should be construed as investment advice, so be sure to consult with your financial advisor before making any decisions. So we just got the news last night that Airbnb had priced their shares for their IPO. They haven't started trading yet this morning, but that initial pricing is at $68 a share, which values the entire company at approximately $47 billion on a completely diluted basis. And it looks like they're raising $3.7 billion. So this is obviously an impressive number. This is much higher than where it's been trading in the private markets over the past few months. To put it in perspective, a valuation of $47 billion for Airbnb, that compares to these valuations for sort of well-known hotel chains, Marriott being the largest at just $42 billion. So it hasn't, the total market cap of Airbnb doesn't equal the combined market cap of all these hotels, but we can see that Airbnb is a huge player in this space. This is the ticker ABNB. You can see, I'll do a refresh here, but it hasn't started trading yet. It should start trading usually around midday, and we'll see where it opens up. I would expect it to open up pretty much much higher than $68 a share. So part of this investment thesis will really depend on what price I'm able to get it for. Make sure you stick around till the end of the video when I'll talk about a possible target price for this. Now, I should say by starting out that when you look at companies like this, the brand is really important, the global brand recognition. And I checked in with my kids yesterday, and I discovered that really the only travel brands that they recognize are Southwest Airlines, Disney, and Airbnb. They had actually never heard of. I think they had heard of it, but these are not strong brands for the younger generations. But Airbnb is a very, very strong brand. And so I think this is important to keep in mind that this company and its name has huge mind share as well as growing market share. One reason the kids know about it is over the years, we've stayed in a lot of Airbnb houses. If you have young kids especially, it's really nice to have a washing machine and have various bedrooms, etc., as all you parents know. In the wake of COVID, obviously, not only does renting an Airbnb house get you more space, but you don't have to worry about the virus being shot out of the sewers whenever someone flushes the toilet or coming through air vents as well. So it'll be very interesting post-COVID as the vaccines get rolled out to see what comes back to hotels and what ends up going into Airbnb. But Airbnb seems to me to be still such a good it's such a good value for what you get. Obviously, business travelers may want something slightly different, though in the age of work from home, etc., the space might actually turn out to be more important than being in a cramped hotel room, even if it's a very fancy hotel room where you still have to share elevators and hallways with people. COVID is probably not the last pandemic that we're going to see. I could see a scenario where we get one of these every couple of years. And so I think people are going to be a lot more aware of this, and this definitely helps Airbnb over the hotels. The other advantage that Airbnb has, which I'm not sure a lot of people have thought about, is that it's what's called a very asset-light business. They don't own a lot of assets. They have a website. They obviously have some buildings where the employees work, though a lot of them are increasingly working at home, I imagine. But this is where they have a huge advantage over the Marriotts and Hiltons of the world, is they don't need to own and maintain buildings. Now, obviously, Hilton and Marriott, they do have these licensing deals where they get a percentage of revenues, but they also still own a lot of traditional buildings. Airbnb, as far as I can tell, doesn't own any hotels. And as such, they just get a percentage of the revenues. This means that's a very high margin business. I calculated for the last 9 months, their margins were above 70%, their gross margins, which is really, this makes it look more like a software company than a hospitality or travel company. The other nice thing about not owning buildings and not being really asset heavy in your business model is that if travel patterns change, so let's say a lot fewer people don't travel to Manhattan as much as they need to, as much as they used to, they can instead do virtual meetings, and maybe people start traveling more to Florida or Arizona or Hawaii. If you are a traditional hotel company, you might need to consider closing some of your New York City hotels and then opening them up in Florida. Airbnb doesn't have this problem because owners of Airbnb rentals will sort of migrate to where the demand is. And so it becomes their problem rather than Airbnb's problem. So as we said, very asset light, very high margin business. This is the great kind of business to own. In their S-1, they talk about their total addressable market being 3.4 trillion, which is obviously huge. Even if they get just 5 or 10% of it, that gives you a fairly large market cap. In terms of the breakdown of where their revenues come from, in their S-1, which is the filing that a company does before it goes public, and I'll link to that later in this video, 80% of the revenue is short-term stays, which they define as 28 days or less. So obviously this shows that people aren't doing a month-to-month rental. And then approximately 20% comes from experiences. If you just Google Airbnb experiences, you'll get this page. This showed up as an ad. And basically they've got lots of activities that you can do not only when you're traveling, but even from home. So here's an example. I'm not sure what city this is in, but novel writing with a best-selling author, Hollywood lighting for the home, treasure hunts. You can go to animal sanctuaries. There's just sort of unlimited adventures, cooking classes, etc. Those are, again, also pure profit. Those basically have close to 100% margins because they're just taking a percentage of what the person who's doing them earns. And so this is a high margin business, and they have a lot of room to expand, not just their core business in terms of short-term stays, sort of replacing hotels. This part of experiences is obviously almost infinitely expandable. If people are spending more time in their hometown, perhaps they'll start using Airbnb experiences to do activities locally or when they're traveling as well. And then there's another category which they don't make a lot of money from yet, but they have a huge amount of room to expand, and this is longer term stays, so more than 28 days. And this is really this rapidly becomes a substitute for the rental market. Maybe you want to stay flexible, you don't want to own a house. You can be like the guy on my channel who sold his house and moved it all into Bitcoin, and then you need a place to stay. So maybe you stay in an Airbnb for 6 months in Thailand, and then 6 months in Croatia or Africa or wherever you want to travel. And so this is obviously, with their brand, they have a lot of room to expand on this long-term stays. Especially, it seems to me, the millennials and the Gen Z generations are less interested in ownership and more interested in experiences. And why have the burdens of home ownership, especially if you plan on traveling, when you can do long-term stays in an Airbnb? So I think the demographics, the mindshare, everything works in Airbnb's favor. If you haven't hit that subscribe button and you're finding this video helpful, be sure to hit it right now, and hit the like button as well. It would really help me out. So we have Airbnb experiences. In addition, we have a company that basically used COVID as an excuse or as a cover to lay off a lot of employees. They laid off approximately 1,900 employees back over the summer. This was approximately 25% of the company. Hopefully this hasn't really compromised the customer service you get over the phone. I haven't used them since February. So this remains to be seen, but they're definitely a much more lean and mean company. This is something that companies will often do before an IPO, and it looks like the COVID thing really accelerated it, and they really needed to cut costs and preserve their cash flow while they were waiting for an IPO. But now, going into an IPO, this looks much better. They have a much lower cost structure, and they're a much more lean and mean machine. I will link here to the S1. This is where I calculated their gross margins. You can see their cost of revenue here as a percentage of their total revenue. Obviously, the company is still losing money like most Silicon Valley companies, but they have a lot of room to move these things around, and also the laying off a quarter of the staff will definitely cut their sales and marketing, probably in their SG&A expense lines here. Now, what are revenues looking like going forward? There have been a couple, I couldn't find this in the S-1, but there have been a couple, I guess, investor presentations that were circulating, and I've seen numbers all over the internet. Airbnb projecting approximately $5 to $6 billion in revenue in 2021. This is assuming a recovery in the economy and a resumption of more travel, I assume. If it doesn't happen in 2021, maybe by the end of 2021, 2022. And so if we take revenues, let's say the revenues in the next year or so are going to be approximately $5 billion. We'll use a fairly conservative number. And it turns out if you take their current market cap of $47 billion, you divide it by $68 a share, that gives you an estimate of about 0.691, 691 million shares outstanding, fully diluted, including all the options, etc. And so if we take that number of shares and we apply if we take $5 billion in revenue and we apply a 20x multiple, so 20x sales, we end up with a $100 billion market cap for the company. Currently trading, as of last night, at a $47 billion market cap, so room to really go up 100%. From here, that gives a per share target of roughly $145 a share. To calculate that, I just took the $100 billion market cap divided by the number of shares outstanding. Now, some people may question why I'm applying such a high multiple. This takes into account a lot of future growth. In addition, this is a company that's very asset light. As we said, it's a high margin business, and as such, it deserves a much higher multiple than you would get for a traditional hotel company. This is definitely more like a Silicon Valley, more like a tech company or software company multiple. But I think it's justified. I think it's quite easy to justify, especially the fact that they have such a huge market that they can expand to, and they can do it in a way that shouldn't hurt their margins very much. And so you can end up with this really global hotel and travel brand. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. I should say I haven't bought Airbnb yet. It's obviously still not trading. We'll have to see where this opens. I don't think this is an opportunity as good as something like Bitcoin. If it opens up at $90 a share or $100 a share, it's a lot less interesting than if it opens up around $68 a share. So we'll keep an eye on this. If I were to buy it, it would be a small position. I'm mostly allocated to Bitcoin at this point, but thought I would cover this for those of you who are interested. Thanks a lot for watching, and I'll see you in the next video.